So today, Bank of America slapped a massive, I think it was a $380 price target on Apple.
Yeah, 380. It's a huge target.
Right. They upgraded their outlook with these incredibly aggressive revenue models. But if you actually looked at the tape today, Apple's stock fell.
Exactly. It dropped.
Yeah, and at the exact same time, Jamie Dimon, the CEO of the largest bank in America, he effectively warned investors not to touch public stocks or treasuries at their current prices.
Which is wild considering the macroeconomic backdrop right now.
I mean, the U.S. labor data looks entirely bulletproof. So, welcome to the Deep Dive, where today we are unpacking a massive, glaring contradiction in the markets for you.
It's definitely a tale of two realities out there.
It really is. We're looking at Tuesday, July 21st, 2026, and the major indexes are telling a completely fractured story.
Yeah, completely split.
Like the tech-heavy Nasdaq closed up 0.57%, while the Dow Jones Industrial Average actually slid 0.30%.
Right, and that split, between the Nasdaq and the Dow, it isn't just some daily blip.
I don't think it's just regular volatility.
No, not at all. It is really the physical manifestation of a two-tiered economy. Like, we are seeing a profound decoupling between the companies building the algorithmic future and, well, the companies building the physical present.
Which is exactly what we need to cut through today. Because looking across the stack of daily briefings here, our overarching mission for you is to trace where the smart capital is actually flowing beneath all these mixed signals.
Right, you have to look past the surface noise.
Yeah, because we have a massive tech hardware arms race kicking into high gear. We've got unprecedented liquidity events brewing in the commercial space sector, and this very quiet, highly coordinated retreat by ultra-wealthy investors into private markets.
It's all connected, too.
It really is. So let's start with the clearest divergence on the board today, which is Alphabet. They surged 3%.
Yeah, huge day for Google.
And the catalyst wasn't, a new search feature or some ad revenue beat. It was entirely based on silicon.
Yes, hardware.
Google is rolling out a brand new proprietary AI chip internally dubbed Frozen V2. Plus, they're expanding their whole Gemini lineup with cheaper models and new cybersecurity stuff.
And that transition, right, from software giant to bespoke hardware manufacturer, it's crossing a point of no return.
Okay, let's unpack this. Because historically, building physical chips is a notoriously brutal, low-margin, high-capex business.
Oh, absolutely. It's a headache.
Right. Compared to licensing enterprise software, it's terrible.
Right.
For a decade, tech giants were perfectly happy outsourcing that exact headache to Intel or TSMC. So what does Frozen V2 actually do that justifies Google getting its hands dirty in the foundry?
What's fascinating here is that it solves a terrifying physics problem, one that basically threatens Google's entire margin structure.
A physics problem.
Yeah, I mean, think about the Frozen V2 architecture. It's purpose-built to run their Gemini models more efficiently. See, a traditional GPU is a generalist. It's incredibly powerful, but it has logic blocks designed for a wide variety of tasks. Rendering graphics, physics simulations, basic math.
Stuff they don't necessarily need for AI.
Exactly. When you run a hyper-specific generative AI model like Gemini on a generalist GPU, a lot of that silicon just sits there, idle.
But it's still plugged in.
Right. It still draws power, and crucially, it generates heat.
Ah, so you're basically paying to cool circuits that aren't even doing the math you need them to do.
Precisely the issue. So by designing an application-specific integrated circuit, an ASIC, that is tailored exclusively to the exact matrix multiplications that Gemini requires, Google can physically rip out all that unused architecture.
Wow.
The result is a chip that operates with drastically lower energy consumption and thermal output.
So efficiency isn't just a buzzword here.
No, it's the key to profitability. When you multiply those energy savings across billions of daily AI queries, Frozen V2 isn't just some hardware upgrade. It is mathematically the only way Google protects its profit margins as compute demands just, scale exponentially.
It feels like they are essentially building the exact size pipe for their specific volume of water, rather than renting a massive leaky reservoir from someone else.
That's a perfect way to look at it.
But Alphabet isn't the only one making structural moves in the data center today. We also saw NVIDIA detailing its next-generation CPU for AI called Vera.
Right, Vera. This is a massive shift.
Which is wild because NVIDIA already has a monopoly on the GPU side of the server rack, building a dedicated central processing unit, the CPU. That feels like a direct declaration of war on traditional players.
Oh, it absolutely is a challenge to traditional players like AMD and Intel.
Are they trying to completely bypass the x86 architecture?
They are attempting to own the entire nervous system of the data center because up until now, an NVIDIA GPU still had to talk to an Intel or AMD CPU just to manage the system logic and route data.
Right, they had to play nice together.
Yeah, and that connection requires data to travel across the motherboard via standard PCIe lanes.
Mm.
But in the world of AI, that physical distance, I mean literally just traveling an inch across copper traces,
Yeah.
it creates a latency bottleneck.
It slows everything down.
Exactly.
Yeah.
So with the Vera CPU paired directly with their own GPUs, NVIDIA can implement proprietary ultra-fast interconnects.
So they're locking you in.
Right. They are basically telling their enterprise clients, stop buying our engines to put in an Intel chassis. Buy the entire NVIDIA vehicle, and we will eliminate the data traffic jams.
Proving that the tech sector is aggressively driving innovation from the silicon all the way up. Which means the battleground has completely shifted from selling individual components to selling deeply integrated monolithic racks.
Exactly, the whole package.
And if everyone is building these bespoke AI roads, the people selling the asphalt must be making an absolute killing.
Oh, they are. The supply chain is stretched to its absolute limit.
Which perfectly explains the broader tape today. The entire semiconductor sector caught a massive tailwind. Specifically, Micron rebounded 4.3%.
Yeah, driven by analyst optimism and expected memory chip price increases.
Broadcom is running up right alongside them too. But if processing power is the engine, why is memory pricing suddenly acting as the primary catalyst for a nearly 5% jump in a stock like Micron?
Because the industry has finally realized that compute power is no longer the primary constraint.
What do you mean?
Well, think of an NVIDIA GPU as this Michelin star chef who can chop vegetables at lightning speed.
Okay, I like that.
Right, so high bandwidth memory, or HBM, that's the prep staff, and their only job is to run back and forth to the fridge to hand the chef the ingredients.
So the memory is the prep staff.
Exactly. And it does not matter if you have the fastest chef in the world, if the prep staff can't carry the data fast enough, the chef just stands there, idle, burning expensive electricity.
Oh, wow. So the bottleneck has entirely migrated. It isn't how fast you can process the data, it's how fast you can retrieve it from storage and feed it to the processor.
That is the exact friction point right now.
Yeah.
These large language models, they require staggering amounts of active memory just to hold their parameters during a single query.
Right, which takes huge capacity.
And the solution is high bandwidth memory, where you physically stack memory chips on top of each other, incredibly close to the logic die, to minimize that distance data has to travel.
That seems incredibly complex to manufacture.
It is phenomenally difficult. Yields are low, and demand is insatiable. So when analysts see that bottleneck tightening, they immediately price in expanding margins for the few companies like Micron that are actually capable of manufacturing it at scale.
Okay, so the infrastructure build-out is clearly accelerating, and the supply chain is pricing in a massive windfall. But here is the massive reality check hanging over this entire hardware party.
Earnings season.
Exactly. Earnings season. We have over 300 companies set to report this week, and for the last 18 months, the market has basically handed out valuation premiums simply for mentioning AI integration on a call.
Yeah, just saying the word AI was enough to get a bump.
Are we finally crossing the Rubicon from the AI hype fear of missing out phase into the show me the money phase?
We are slamming into that transition right now. The market is looking at the tens of billions of dollars Alphabet, Meta, and Microsoft are spending on these custom ASICs, the NVIDIA Vera racks, the Micron HBM stacks.
It's a staggering amount of capital expenditure.
Right, and that CapEx has to be justified by actual incremental software revenue. Investors are looking for one specific thing right now, and that's clarity on AI spending.
They want to know if it's actually working.
Exactly. They're analyzing these earnings reports to see if the adoption of AI tools by end users is growing fast enough to cover the depreciation schedules of these billion-dollar data centers.
I see. So if a SaaS company reports that they've integrated an AI copilot, but they can't show a corresponding bump in their subscription pricing or like a massive reduction in their internal costs, what happens to the stock?
The valuation multiples just collapse.
Wow, just like that.
Yeah, because if the enterprise software layer cannot monetize the AI capabilities, they will abruptly stop ordering new server racks. And the ripple effect would immediately hit NVIDIA, Micron, and Broadcom.
So that's the litmus test for the whole sector.
That is exactly why this specific earnings season is so critical. It will definitively prove whether the current hardware supercycle is fundamentally sound, or if it's just a massive industry-wide overbuild driven by speculative panic.
The tension there is palpable. And speaking of massive investments and highly anticipated earnings, that demand for complex data processing isn't just isolated to traditional enterprise software.
No, not at all.
It actually provides the perfect connective tissue to the most volatile action on our board today. Because the data demands of AI completely parallel the data demands of the commercial space race.
They absolutely do.
Which is why a single announcement in the aerospace sector just sent massive shockwaves through the IT hardware market. SpaceX formally announced its maiden earnings report will drop on August 4th.
That is a watershed moment for private markets.
It really is. The stock gained today purely on the announcement of the date, weeks before any actual numbers are even published.
Right, just the date moving the needle.
And the briefing mentions this could trigger a big share unlock. So what does this all mean? Why does a maiden earnings report suddenly make a stock jump today?
Well, it really comes down to the mechanics of share unlocks, price discovery, and just the sheer scarcity of exponential growth in public markets right now.
Okay, break that down for us.
So for years, SpaceX has operated in the dark, right? Raising capital at privately negotiated valuations. Insiders and early backers have been holding this illiquid equity for over a decade.
Right. They haven't been able to just go sell it on E-Trade.
Exactly. So when that massive block of early investor shares becomes liquid after the earnings report, it will be the first time public market dynamics actually dictate the company's true clearing price.
So institutional managers are buying in now.
Yeah, they're positioning themselves now because they suspect the underlying financial health of the company, specifically the cash flow generated by the Starlink satellite network, is significantly stronger than the last private funding round indicated.
They want to establish their core position before retail enthusiasm and passive index funds are forced to blindly buy into the momentum.
Exactly. Get in before the floodgates open.
And what's wild is the gravitational pull of that SpaceX announcement didn't stop at the aerospace border. Look at Supermicro today.
Oh yeah, Supermicro was wild.
It surged a massive 15% today, making it the top gainer on the entire board, directly linked to new order and margin disclosures following the SpaceX news.
Right.
But how does a rocket company disclosing its earnings date trigger a 15% spike in a company that builds metal server racks?
This brings us right back to the thermal physics we were just discussing with Google's custom chips.
Okay, how so?
Think about the telemetry required to land a reusable orbital booster on a drone ship in the middle of the ocean, or the real-time fluid dynamics simulations required to optimize the burn rate of a Raptor engine.
It's an unfathomable amount of math happening every second.
Right. SpaceX is generating exabytes of operational data that must be processed locally and immediately.
Right, you can't rely on a standard cloud connection when calculating atmospheric reentry vectors in real time. You need massive on-premise computing power.
Exactly.
Yeah.
And you cannot put an ultra-dense cluster of next-generation AI processors into a standard air-cooled data center.
They would just melt.
It will literally melt. So Supermicro's core competitive advantage is advanced thermal engineering, specifically direct-to-chip liquid cooling architectures.
Oh, I see.
Yeah, that allows companies like SpaceX to cram maximum compute density into a minimal physical footprint. So when the market sees SpaceX accelerating toward public maturity, they immediately bid up the hyper-specialized infrastructure providers that make that scale physically possible.
It just shows how intertwined these futuristic sectors are becoming. A space exploration milestone is functionally a massive IT procurement event.
It's all the same ecosystem now.
We're also seeing Tesla poised for its biggest earnings move in a year, further compounding this whole convergence of heavy industry and next-generation compute. But let's pull back from the aerospace and AI euphoria for a second.
Really good idea.
Because this is where the split-screen economy we mentioned at the very start comes right back into sharp focus.
The macroeconomic reality is telling a much, much more cautious story than the semiconductor tape.
Decidedly so. I mean, bringing this back down to earth, the U.S. economy is actually showing resilience. We've got steady growth. The labor market is holding strong.
By all traditional lagging indicators, things look incredibly solid.
Yet, Jamie Dimon stepped up today and delivered a remarkably blunt warning. He explicitly stated that markets are wildly underestimating systemic risks.
Yeah, that was quite the statement.
He essentially said he would not buy stocks or treasuries at their current elevated prices. To see the CEO of JP Morgan Chase look at a strong labor market and basically tell investors to go to cash, it's jarring.
It is jarring. But You know, Diamond is not looking at the rearview mirror of employment data. He is looking at the windshield of asset valuations.
Right.
When you evaluate the equity risk premium, which is the extra return you expect to earn by investing in volatile stocks instead of risk-free government bonds, the margin of safety right now is practically zero.
Because, I mean, if you can get a guaranteed 5% yield on short-term paper, the stock market has to offer a massive upside to justify the inherent risk.
Exactly. And right now, public equities are priced for absolute perfection. The current multiples assume inflation will smoothly return to 2%, the Federal Reserve will perfectly time interest rate cuts without triggering a recession, and that every major tech company will flawlessly execute on their multi-billion-dollar AI investments.
Which is a lot of things that have to go exactly right.
Right, so Diamond is analyzing the geopolitical friction points, the exhaustion of the consumer credit cycle, and the sheer weight of these valuation expectations. And he's concluding that the market is structurally fragile.
Meaning any tiny shock could break it.
Any single misstep, a hot inflation print, an earnings miss by a mega-cap tech stock, it could trigger a massive cascading repricing.
Which totally explains the bizarre price action we saw with Apple today. Because even top-tier stocks are feeling this mixed sentiment. You have Wamsi Mohan at Bank of America issuing that glowing buy rating and setting a $380 price target, clearly modeling in massive revenue streams from future AI integrations.
Yeah, very bullish on paper.
Yet, Apple fell 2.3% today, landing right on the top losers list, alongside traditional industrial bellwethers like Caterpillar, which slid 1.2%. How do you analyze that cognitive dissonance?
Well, that price action is the exact fragility Diamond is warning about. When a stock like Apple drops on the same day, it receives a major analyst upgrade. It signals a fundamental exhaustion in buyer momentum.
Like they just don't have the energy to push it higher.
Exactly. The institutional sentiment is completely decoupling from the optimistic analyst models. Investors are looking at the extended valuations, they're looking at the macro risks Diamond highlighted, and they're actively deciding to take profits off the table rather than chase those final few dollars of potential upside.
So the risk-reward ratio in public markets has just skewed entirely too far toward risk.
Right, it's out of balance.
And if the public markets are starting to feel like a crowded, volatile roller coaster right now, where great companies are routinely punished despite strong fundamentals, how is the smart money reacting?
They're finding a new playground.
Because they aren't just sitting in cash under a mattress. And the answer lies in a major strategic pivot announced today. Goldman Sachs is officially launching a massive new alternative investments platform geared directly toward family offices and ultra-high net worth clients.
Yes. And this is the quietest, yet arguably the most consequential data point of the day.
Really? More than the AI chips?
I think so. It represents the institutionalization of the private wealth retreat.
It sounds like Goldman is just building a private theme park for family offices.
That's exactly what it is. We are seeing a coordinated effort to build bespoke private ecosystems. Because the public markets mandate relentless quarterly earnings pressure, constant mark-to-market volatility based on algorithmic trading, and, total regulatory transparency.
Which can be a massive headache if you just want steady returns.
Exactly. Goldman is offering a structural escape hatch from all of that noise. It's the privatization of alpha. For the last 2 decades, the bulk of exponential wealth creation occurred in the private markets. By the time a company like Uber or Airbnb or eventually SpaceX actually lists on a public exchange, the steep slope of that growth curve has already been captured by venture capital and private equity.
So the ultra-wealthy understand that public markets have essentially become a high-priced exit liquidity mechanism for private funds.
Precisely. They want direct stakes in the underlying private companies because they offer different risk profiles and potentially higher returns.
They want in before they are subjected to the daily ticker.
Right. By moving capital into alternative investment platforms like Goldman's new venture, family offices are basically trading immediate liquidity for structural control. And, most importantly, shelter from macroeconomic sentiment swings.
Shielding them from the daily volatility.
Exactly. They do not want to watch their net worth fluctuate by 3% on a random Tuesday just because some hedge fund decided to dump Apple shares based on a minor change in the bond yield curve.
So we have to synthesize these massive colliding forces for you to watch this week. On one hand, you have an undeniable physical restructuring of the global technology stack.
Aggressive tech innovation.
Right. Alphabet is ripping up standard architectures to build frozen V2 chips. NVIDIA is aggressively attempting a takeover of the server rack with their Vera CPUs. And Supermicro is surging 15%, pushing the absolute limits of thermal engineering to support unprecedented data demands from both AI and space.
It's a technological leap that is physically reshaping industrial supply chains.
But on the other side of the equation, that hyper-aggressive innovation is slamming directly into a wall of macroeconomic caution. You have Jamie Dimon explicitly warning away from current public valuations, traditional stalwarts like Caterpillar bleeding out, and the smartest, most concentrated capital quietly abandoning the public exchanges to seek shelter in bespoke private platforms.
It is the ultimate collision of technological optimism and financial gravity.
So, the immediate takeaway for you, the listener, is to track how those 300-plus companies reporting earnings this week justify their AI spending. Because if they cannot prove the immediate return on investment for their massive hardware purchases, the caution Jamie Dimon is preaching could very quickly overwhelm the semiconductor euphoria. It will likely dictate the market's direction for the rest of the summer.
And if we look at the underlying currents connecting all of these seemingly disparate events today, there is a final, broader structural shift that demands your attention.
Let's hear it. Leave us with something to chew on.
Think about the nature of the innovations we broke down today. Alphabet's custom AI silicon, the hyper-specific liquid cooling architectures, the proprietary language models, these are all fiercely protected, internally siloed secrets.
Right, nobody is sharing these blueprints.
Exactly. These are not open-source protocols. They are competitive moats built out of bespoke physics. Now, combine that reality with the financial movements we are seeing.
The flight to private wealth platforms.
Right. The ultra-wealthy are actively migrating their capital away from transparent public exchanges and into opaque, exclusive, alternative platforms orchestrated by banks like Goldman Sachs. So the technology is going proprietary and the capital is going private.
Wow, okay.
We are watching the key drivers of wealth creation actively retreat from the public square. So it raises a critical question for the next decade of investing. Are we accelerating toward a bifurcated reality where the most important economic maneuvers, the true engines of global growth, happen entirely in the shadows, far away from the daily ticker of the Dow and the Nasdaq?
Leaving the retail investor to trade the exhausted remnants. If that structural shift is already underway, the fractured split-screen market we analyze today isn't just an anomaly, it is the new blueprint. And that is all for today's deep dive into the market madness. We'll be back tomorrow to cut through the noise once again.